Welcome back to Bloomberg North. I'm Rudyard Griffiths. Well, our show today is on NIRP, negative interest rate policy. It's an acronym you got to know, you got to understand, because it can affect your investments and it can affect how we think about risk and reward in the global economy. To unpack for us investment strategies, defensive and offensive, let's go to Robert Janson. He's the Chief Investment Officer at Westcourt Capital, and he joins me here in studio. Robert, great to have you back on the show.
Thank you very much. Good to be back.
So let's talk about this. What do you do? I mean, should you be defensive in the face of negative interest rates? Is this a big red flashing siren that says the global economy is in rough shape? Or in fact, is this an opportunity to look at different asset classes as a way to actually make money off a negative interest rate world?
I think we're definitely in uncharted waters. I wouldn't say it's a red light, but it's clearly a yellow light. The vast majority of these central banks and these policies that have been implemented have only started in the past couple of months, or past few quarters. And so we don't know yet exactly how it's going to play out. But it is true that one has to be very, very careful with regards to the way the world is going. And if I'm a private investor, I have access to potentially different asset classes here in Canada. And it is very different for a large institutional investor when they have to, by policy, hold a certain amount of sovereign debt. They're somewhat hamstrung and really handcuffed to that sovereign debt and those negative interest rates.
Now, explain to me, again, investors thinking of the United States, Janet Yellen, the potential raising interest rates, arguably because she thinks inflation is there, the animal spirits have awoken. How do you do that in the face of a world that the rest of it's going to negative rates and deflation and anything but the specter of inflation?
It is, and as I said, it's a scary time. I think there's been a big departure from the sort of G7, G8, G10 countries originally working quite well together. Post-crisis, you've had central banks and really governments look more internally, inward looking really into their own economy and their own markets, their own progress, really. And if you take Yellen and the U.S., I think they're well poised to continue on with potentially a rate hike in June and further rate hikes. And I think that's really because, obviously, they're more focused on their own domestic economy and where they're going. And everybody is really inward looking and less working together in that sort of global capacity.
Now, would you buy Japanese debt?
I wouldn't, and it's quite interesting with regards to...
But again, why not? I mean, if it falls further, you'd make money.
Potentially. But listen, if the 90s were the lost decade in Japan, it might be a lost generation or lost generations now with an S. They've had an extreme problem with regards to reviving their economy, having any sort of growth come in the past 10, 20 years. And they implemented negative interest rates in January, and it was a complete and utter flop. You had two elements that were really led them into a great amount of difficulty. First, you had the currency that was hopefully going to devalue. That actually appreciated. And normally when you have negative interest rates, people are redeeming or not investing in that government debt that's negative, and they're investing more in riskier asset classes. And albeit that was the thesis, in January to April, unfortunately, the Nikkei fell by 6.5%.
And so the currency appreciated.
And the currency appreciated. So you've got this double whammy of sort of negative aspects to them implementing it, a few months ago.
A minute or so left. Gold. I mean, does gold get more interesting in a world of negative interest rates? It can't be manipulated by a central bank unless they've got a secret gold mine out there that I don't know about.
I think it is something to look at. I mean, gold has been on fire over the past few months. You've seen a major rally in gold producers and in gold itself coming off very, very low lows. But gold is an asset class that is not yield producing. It's a difficult one, and it's a difficult one to find and to put in one's portfolio, only simply because it's very different from any other asset class. Is there a place for it? Yes. And could there be, a very, very interesting sort of uptick with the price of gold that comes with inflation? Yes, but that again comes from the fact that negative interest rates work, and we have inflation that picks up, so that we don't know yet.
30 seconds. What do you like? Land? Do you like, a gun and a tin of chili soup or something to the hills?
If this policy works and we're able to inflate our way out of it, yes, I like real assets, since that can be real estate, it can be gold, it can be farmland, it can be agriculture, it can be oil and commodities, and so Canada is well poised to do well. If it doesn't work, it is going to be a very, very scary time. And again, it comes back to, we thought quantitative easing was the last lever. This is truly the last lever, and it was always academic, and now that's being put in place around the world.
Great.
So
well,
difficult.
Robert, thank you. Fascinating conversation, fascinating stuff. Ladies and gentlemen, just in the final moments, I'll give you my 60 seconds or less thoughts on this. Negative interest rates, I think they're here.